Welcome to Quantum Metals, where reality meets preparation and every number on your screen tells a story you're not being told. Today, we're uncovering a hidden truth: the money you trust, the savings you count on, and the stability you assume are quietly losing value. This is not fear, it's awareness. Silver, gold, and other tangible assets aren't just investments, they're signals of systemic risk. In the next few minutes, you'll discover why being informed, calm, and prepared gives you an edge that most people will never have. What feels safe today may crumble tomorrow, but clarity transforms risk into opportunity.
Most people have been trained to believe that their money is safe, that the numbers in their bank account, the balances on a screen represent security and stability. But the reality is far more complicated. Modern financial systems are built on debt, and debt always comes with consequences. When governments spend more than they collect, they generate new money to cover the difference. On the surface, this seems harmless, even necessary, but in reality, this process erodes the purchasing power of every single unit of currency already in circulation. Every dollar, every euro, every yen is subtly losing value almost invisibly, and most people don't notice until it's too late. This is not speculation, it is structural reality. Currency debasement is baked into the system. Inflation is just one symptom behind the scenes. The system depends on continued expansion, more debt, more spending, more printing. If growth slows, if trust falters, or if confidence in the currency wavers, the entire structure becomes unstable. Everyday savers, retirees, and workers are the ones quietly losing, often without understanding why. Precious metals, particularly silver, have historically served as a warning and as a hedge. Unlike paper currencies, silver cannot be created out of thin air. It is limited by physical supply, it is consumed in industry, and it holds intrinsic value independent of government promises. This dual role, industrial and monetary, makes silver uniquely sensitive to economic stress. It is not speculative mania that drives its price. It is the slow, steady recognition that fiat money is weakening. Another critical factor is the difference between paper claims and physical ownership. The majority of silver traded globally exists as contracts, promises, or derivative instruments. These paper markets create an illusion of abundance and liquidity, but they are fragile. When demand for actual delivery rises, shortages appear. The system reacts, often violently. Those who wait for confirmation risk arriving too late. Preparedness and physical possession are not optional. They are essential to navigating this quietly unfolding crisis. Most people ignore these realities because they feel abstract. Inflation is slow. Currency devaluation is gradual. Banks, brokers, and governments all reassure you that everything is fine. But this is exactly the moment when awareness matters most. By the time the crisis becomes obvious, the window for effective preparation has closed. What feels safe now, checking balances, relying on fixed accounts, is often where the greatest risk lies. The key is understanding incentives and patterns. Debt-based money systems always reach a breaking point. Prices of goods and services rise, savings lose value, and confidence is tested. Historically, people who recognize these signals early, who understand the difference between paper exposure and real assets, and who act rationally and calmly, are able to preserve and even enhance their wealth during transitions. Those who wait for certainty or reassurance are almost always left behind. This is not about fear. It is about clarity. The silent crisis in money is happening whether you notice it or not. Each decision you make, from the savings you hold to the investments you choose, should be informed by the understanding that the system is designed to reward the informed and punish the unaware. Awareness is the first step. Preparation is the second. And acting rationally before the obvious signs appear is the final decisive step. Because when trust in paper money erodes, there is no warning louder than reality itself. Silver, real assets and systemic risk. When it comes to preserving wealth in a system built on debt, few tools are as effective as tangible physical assets. Among these, silver stands out not just as a store of value, but as a critical asset that has both monetary and industrial importance. Its role is unique. Unlike gold, which is primarily hoarded and rarely consumed, silver circulates actively in industry. Electronics, solar panels, medical devices, and various technologies all require silver. Once it is used, it is often consumed or embedded, making supply finite. This is a fundamental reason why silver reacts to stress in the financial system faster and more dramatically than most assets. Understanding the supply dynamics is crucial. Global silver production is limited, and much of it comes as a byproduct of mining other metals. There is no way to quickly increase supply if demand suddenly spikes. Meanwhile, the paper markets, the contracts and derivative instruments that claim to represent silver, create the illusion of abundance. These markets are leveraged, meaning that the amount of paper silver far exceeds the physical silver available. When confidence shifts and buyers demand actual delivery, shortages emerge quickly, often accompanied by sudden price swings. Recognizing the difference between paper claims and real ownership is not optional, it is essential. Another dimension of risk is the broader monetary system. Debt-based currencies rely on constant expansion and public confidence. When inflation accelerates or the public begins to doubt the system's stability, the value of fiat currencies erodes. Even when numbers on a screen appear stable, the underlying reality is different. The purchasing power of cash, savings, and fixed income instruments declines slowly but steadily. Assets that are tangible, limited, and historically trusted, like silver, are not affected by promises. They hold intrinsic value, independent of government or institutional credibility. This is where preparation becomes a matter of timing and discipline. Waiting for the crisis to announce itself guarantees that opportunities have passed. The early recognition of systemic stress allows for strategic positioning in tangible assets. It is not about speculation, it is about preservation. Investing in silver is not a gamble on price movement. It is a rational response to a predictable structural weakness in the system. Historical patterns confirm this. In every major currency devaluation or systemic disruption, silver consistently preserves wealth, while paper instruments fail. Diversification remains essential. While silver provides protection, other real assets like gold, essential commodities, and property also play a role. The principle is the same: hold value that cannot be artificially created or destroyed. This approach shields you from systemic risk, provides leverage against inflation, and reduces dependency on fragile financial instruments. Emotional discipline is key. Reacting impulsively to short-term market fluctuations undermines the very advantage tangible assets. Finally, awareness and education cannot be overstated. Most individuals are misled by appearances, reassured by institutions, and lulled into a false sense of security. By understanding supply constraints, monetary incentives, and the role of tangible assets, you gain insight that others lack. This insight is not theoretical, it is actionable. It guides decisions that protect purchasing power, ensure liquidity when it is most needed, and create a foundation for long-term financial resilience. The takeaway is clear. The system rewards preparation and rational understanding, punishes naivety and complacency. Silver and other real assets are not magic. They are tools for clarity, security, and action in a world where the promises of paper money are increasingly unreliable. When this reality is understood and applied consistently, you move from passive concern to active control, and in control lies your advantage. Recognizing systemic warning signs. The truth about the financial system is that it rarely fails overnight. Crises don't erupt suddenly. They build quietly, invisibly, and often in plain sight. Those who are unprepared dismiss early signals, distracted by daily news cycles, politics, or short-term market movements. But anyone paying close attention can recognize the patterns: unsustainable debt growth, central bank interventions, currency debasement, and excessive leverage. These are the systemic warning signs that the system is under stress. One of the clearest indicators is debt expansion. Governments and institutions constantly create more money to fund obligations. While it may feel normal because this has been ongoing for decades, the magnitude and pace of borrowing matter. When debt grows faster than economic output, it becomes structurally unmanageable. This is invisible inflation, the silent erosion of currency value. It does not show up in headlines every day, but it is occurring continuously. Numbers may look fine on a balance sheet, but the real purchasing power of money is steadily declining. Another warning sign is central bank activity. Low interest rates, quantitative easing, and artificial market support create distortions. They temporarily inflate asset prices and suppress natural market signals. While many see this as stability, it is actually a distortion of reality. Artificially inflated markets encourage risky behavior, encourage over-leverage, and hide vulnerabilities that eventually surface under stress. The more dependent a system becomes on intervention, the greater the eventual shock when that intervention cannot continue.
Inflation is also a critical signal.
People often underestimate the impact of slowly rising prices. While inflation may feel manageable on a month-to-month basis, over time it compounds. It erodes savings, reduces real incomes, and shifts wealth from the general public to those who control debt instruments, commodities, and real assets. Tangible assets like silver, gold, and essential commodities behave differently. They retain intrinsic value and act as a hedge against both predictable and unforeseen monetary distortions. Global imbalances provide further warning. Trade deficits, currency manipulation, and uneven economic policies across regions increase systemic risk. When one major currency weakens, the ripple effects are immediate. Markets are interconnected, meaning stress in one system quickly transfers to others. Those who understand these patterns can anticipate stress points rather than reacting after the fact. Finally, the behavior of markets themselves provides signals. Unusual volatility, divergence between paper markets and real asset availability, and abnormal pricing trends indicate stress in the underlying system. These are not random anomalies. They reflect structural weaknesses and misalignment between perception and reality. Observing these patterns over time allows rational, calm preparation rather than panic-driven decisions. The lesson is simple. Waiting for obvious crisis is too late. Those who prepare early do not act out of fear. They act out of understanding. They acquire tangible assets. manage exposure to weak instruments, and maintain liquidity in ways that allow them to withstand systemic shocks. Awareness transforms uncertainty into opportunity. Ignorance guarantees vulnerability. This is the advantage of recognizing warning signs. They allow you to position yourself strategically, make informed decisions, and maintain control over your financial future. The system is not failing because of luck. It is failing because of structural incentives and predictable human behavior. Those who understand and respond rationally will navigate this transition successfully, while those who ignore it will be forced to react under pressure. The system is not collapsing by accident. It is following patterns we can predict, understand, and prepare for. Tangible assets like silver, gold, and essential resources are not about speculation. They are about awareness, preservation, and control. Those who act with knowledge and calm will navigate these shifts successfully. Those who wait for certainty will be caught unprepared. The choice is yours. Remain passive and risk being at the mercy of a system built on debt, or take informed, rational steps today that give you security tomorrow. Clarity is power, preparation is freedom, and understanding is your greatest advantage.